You convert money into a Roth IRA, thinking it's done. Tax-free forever, completely flexible, safe. Then life happens. You need $35,000 for an emergency. You pull it from your Roth because that is what Roth money is for, right? And then the IRS sends you a bill. Penalties, extra taxes, thousands of dollars gone from an account you specifically chose because you thought it was protected. This happens to real people every single year, not because they made a bad investment, not because they broke any law intentionally, but because there are actually two separate 5-year rules inside the Roth IRA system, and almost nobody explains both of them clearly. Today, we fix that, once and for all. The two 5-year rules. Let us start with the foundation, because if you mix these two rules up, every strategy conversation that follows falls apart. The first 5-year rule, the account rule, this one applies to earnings inside your Roth IRA. For your investment gains to come out completely tax-free, two conditions must both be true at the same time. Number one, your Roth IRA account must have been open for at least 5 years. The clock starts January 1st of the tax year in which you made your very first Roth IRA contribution or conversion, not the calendar date you opened the account. January 1st of that year. Number two, you must be at least 59 and a half. If both conditions are met, earnings come out completely tax-free and penalty-free. If either condition is missing, earnings become taxable and potentially subject to a 10% early withdrawal penalty. The second 5-year rule, the conversion rule, this is the one that catches people completely off guard. Every single Roth conversion you make starts its own independent 5-year clock, and if you withdraw the converted amount before that 5-year period ends and you are under age 59 and a half, the IRS hits you with a 10% penalty on the converted amount. Not on earnings, on the principal you already paid taxes on when you converted. One account, multiple clocks, all running simultaneously, all carrying their own penalty exposure if you withdraw in the wrong order. Let's make this completely concrete before we go deeper. Say you convert $50,000 from a traditional IRA to a Roth IRA in 2026. You pay taxes on that $50,000 at conversion. It's now sitting in your Roth, fully paid for, tax settled. But that specific $50,000 conversion has its own 5-year clock. That clock began January 1st, 2026, and it does not expire until December 31st, 2030. If you are under age 59 and a half and you withdraw any of that $50,000 before December 31st, 2030 for any reason, the IRS assesses a 10% penalty on the amount you withdrew. On $50,000, that's $5,000, plus possible additional taxes depending on your situation. The money was already taxed, and you could still face a penalty pulling it back out. Now, multiply that across a series of annual conversions, each with its own clock, each with its own exposure window, and you see how quickly this becomes complicated and exactly how David and Maria walked straight into a $6,800 mistake. David and Maria's story. Meet David and Maria, both 58 years old, living in Texas. Over 10 years of disciplined saving, they built up $480,000 in traditional IRAs. About 3 years ago, their financial advisor introduced them to the Roth conversion ladder, a strategy where you convert portions of your traditional IRA to a Roth every year, ideally during lower income years, to reduce future RMDs and build tax-free retirement income. It's a smart strategy. They executed it well. Over 3 consecutive years, they converted roughly $60,000 per year, a 2022 conversion, a 2023 conversion, and a 2024 conversion, each sitting in their Roth account with its own 5-year clock running quietly in the background. Last year, their HVAC system failed and their roof needed emergency repair. They needed $35,000 fast. Their Roth had over $200,000 in it. The money was there. They pulled $35,000 without checking which conversion bucket they were pulling from. Their advisor hadn't built a detailed withdrawal order tracking system. The $35,000 came from their most recent conversion, the 2024 bucket, which still had 3 years left on its 5-year clock. David and Maria were both 58, under 59 and a half. The 10% penalty applied. On $35,000, that's $3,500 immediately. But it didn't stop there. The withdrawal also pushed them into a slightly higher bracket and reduced a credit they'd been counting on. Total damage, over $6,800. Not catastrophic, but completely avoidable. Here's the painful part. Their Roth had older conversion buckets from 2022 that were past their 5-year window. If they had withdrawn from those instead, the penalty would have been exactly 0. Same account, same money, different bucket, 0 penalty. The only thing separating those two outcomes was knowing the order. 2 scenarios. Let us lay it plainly. Scenario A, the common mistake. David and Maria are under 59 and a half. They need $35,000. They pull from their most recent conversion without checking dates. Clock has not expired. Penalty, $3,500. Additional tax impact, $3,300. Total cost, $6,800. They do not realize it until tax season. Scenario B, the correct order. David and Maria check their conversion records before withdrawing. They identify the 2022 bucket, past the 5-year mark. They pull $35,000 from that bucket instead. Penalty, 0. Tax impact, 0. Full $35,000 available for the repairs. Now, extend that discipline across 8 years of strategic Roth withdrawals, consistently pulling from the oldest eligible buckets, letting newer conversions age properly, and the cumulative difference in taxes and penalties preserved easily exceeds $40,000. Same account, same strategy, same income, completely different financial outcome based entirely on withdrawal order. This is not complicated to execute. It only requires one thing: a simple record of each conversion date and amount, a spreadsheet, a note, anything that tells you which bucket is safe before you pull from it. Here is the reframe. Most people hear Roth IRA and think flexible, tax-free, no rules. And compared to a traditional IRA, that is largely true, especially once you are over 59 and a half and your account has been open 5 years or more. But the Roth IRA is not a completely rule-free account. It is a structured account with specific ordering rules that, when followed, give you extraordinary flexibility and 0 taxes. The system is not designed to trap you. It is designed to reward people who understand the sequence. Once you know the order, the traps disappear. But here's where it gets even more important, and where most people making Roth conversions as part of their retirement strategy make a second mistake they never see coming. It happens when Roth conversions overlap with RMD planning, and the interaction between those two strategies can quietly undermine both at the same time. I will walk through that exactly right after the ordering rules. Let us cover the IRS ordering rules, because once you understand these, you have the complete map. And to make it real, let's use a simple example as we go. Say Sarah has a Roth IRA with 3 types of money inside it. $15,000 she contributed directly over the years, $50,000 in conversions, a $30,000 conversion from 2022 and a $20,000 conversion from 2024, and $30,000 in investment earnings. Total account, $95,000. She needs $20,000. Which money comes out first? Layer 1, regular contributions. The IRS says contributions always come out first. Sarah's $15,000 in direct contributions come out before anything else. This money has already been taxed. It is never subject to income tax or penalty on withdrawal, regardless of her age, regardless of how long the account has been open. So Sarah pulls $15,000 from Layer 1, 0 tax, 0 penalty. She still needs $5,000 more. Layer 2, converted amounts, oldest first. After contributions are gone, conversions come out next in chronological order, oldest first. Sarah's 2022 conversion was $30,000. The 5-year clock on that conversion expired December 31st, 2026. She's 57 years old. She pulls the remaining $5,000 she needs from the 2022 bucket. The clock has expired. Even under 59 and a half, that conversion is past its window. Zero penalty. If the 2022 bucket were not yet expired, or if she needed more than $30,000, she would hit the 2024 bucket next. That clock has not expired. Under 59 and a half, penalty applies. Layer 3, earnings. Earnings come out last and are the most restricted. To withdraw earnings tax-free and penalty-free, both conditions must be met. Account open 5+ years and age 59 and a half or older. Sarah, at 57, would owe taxes and penalty on any earnings withdrawn. This ordering structure actually works in your favor once you understand it. Contributions give you a penalty-free emergency buffer at the top. Conversions age in line below. Earnings are fully protected at the bottom until you qualify. The Roth ladder, and why state taxes matter everywhere. The Roth conversion ladder has become popular among early retirees. Convert each year, wait 5 years per conversion, then withdraw penalty-free as each bucket matures. The math on this strategy varies significantly by state. Some states do not tax Roth conversions at the state level, meaning the only tax event is the federal conversion itself. Other states tax conversions as ordinary income, which meaningfully changes the net benefit calculation. Before building a Roth ladder, confirm how your specific state treats conversion income. That single variable can shift the value of the strategy by thousands of dollars per conversion year. The Roth ladder interaction, the trap that hits conversion-heavy savers hardest. Once RMDs begin at age 73 or 75, depending on your birth year, you are required to withdraw a minimum amount from your traditional IRA each year. You cannot satisfy your RMD with Roth withdrawals because Roth IRAs carry no RMDs during the original owner's lifetime. The mistake? Assuming aggressive Roth conversions will eliminate the RMD problem entirely. In some cases, that is true, but if conversions were done in high-income years, the tax cost of converting may have exceeded the tax savings from reduced future RMDs. The interaction between conversion strategy and RMD planning is a calculation, not a formula. It requires projecting income across multiple years, accounting for Social Security timing, Medicare surcharges, and your specific bracket in each year. Now, let me be precise about who these rules most affect, because there is a large group of Roth owners for whom most of this complexity simply does not apply. If you are already past age 59 and a half and your Roth account has been open for more than 5 years, you have reached what the IRS calls qualified distribution status. At that point, every withdrawal from your Roth, contributions, conversions, and earnings, comes out completely tax-free and completely penalty-free. The conversion clocks no longer matter. The ordering rules no longer affect your outcome. The Roth is exactly as simple and flexible as the brochure promised. For this group, and it is a large group, today's video is mostly good news. You are already in the clear. The complexity in this video primarily affects 2 situations: those under 59 and a half doing conversions as part of an early retirement or tax reduction strategy, and those over 59 and a half whose Roth account is newer than 5 years, meaning earnings are still restricted. If you have urgent financial need and must withdraw regardless of penalty, life circumstances always take priority over optimization. Here's what I want you to hold on to. The Roth IRA is still one of the most powerful retirement accounts ever created. Tax-free growth, no RMDs, completely flexible once you hit qualified distribution status. Nothing changes that. But the 5-year rules are real, the conversion clocks run independently, and the ordering rules determine how much you keep versus how much you hand back to the IRS unnecessarily. The good news? These traps are not complicated to avoid once you know where they are. Track your conversion dates, withdraw in the right order, know which bucket is safe before you pull from it. What part of the Roth 5-year rules surprised you most today? Drop it in the comments. I read every one and it shapes what I cover next. Subscribe because next week I'm covering the inherited Roth IRA rule that catches most adult children completely off guard, the 10-year rule, and the one exception most people never hear about.